If you're a parent thinking about taking out a Parent Plus loan for your student, or you already have, this video is for you, not your student, you. Because the rules around Parent Plus loans have changed drastically under the One Big Beautiful Bill Act, and there are 3 specific changes that can affect your bank account: how much you can borrow, how much it will cost you in interest, and how you're allowed to pay it back. I'm going to walk you through all 3 of these changes with real numbers so that you can make an informed decision with your eyes open instead of after you sign your promissory note. Let's go. Let's start with the headline change because it affects every single parent who is considering taking out this loan. And that is, how much are you allowed to borrow? Based on the new law, loans that are dispersed on or after July 1st of 2026 will now have a hard annual cap. This annual cap is $20,000 per child with a lifetime limit of $65,000 per child. And that is a fundamental shift. Under the old rules, parents were able to take out up to the full cost of their students' full cost of attendance. That includes tuition, books, room and board, all of it, minus what the student has already won through scholarships or financial aid themselves. There was essentially no ceiling, no cap at all for parents who wanted to support their student going to school. Now there is a ceiling, and for some families that can make a big difference. A $65,000 cap may not be able to cover even 2 years if your student is considering a private college or even an out-of-state college. So what do we need to figure out first? We need to identify the gap. What is the gap that parents need to fill after their student has already been awarded? So you want to figure out, what is the full cost of attendance for my student's college? And then what kind of aid have they received? Subtract that from the amount. What is the remaining number? Now, if this number is above $20,000, then we already know we need help closing the gap. Now, here's another thing to think about. What if you have more than one child who's also in school? Now, again, the rules say that you have a $20,000 cap per child. So that means if you have 2 child in school, then you have $20,000 for one and $20,000 for the other, for a $40,000 limit for the year. And if you're looking at the cap of $65,000 per student, that's $130,000 in Parent Plus loans alone. Now, there's another thing I want to point out here. This says per child. It does not say per parent. So let's say that you're a parent, maybe you're a single parent, maybe you're a divorced parent, or maybe you're a separated parent. Then that means if it's a $20,000 cap for the child for the year, that means one parent might be able to take out $10,000, the other might be able to take out the other $10,000 for a total of $20,000. It is not one parent gets to take out $20,000 per child and another parent gets to take out $20,000 per child for a total of $40,000 per that student. It is $20,000 total per child. Now that is a significant piece of information that you may have to consider. Now, is there any exceptions to this? Well, I'm glad that you asked. There's only one. So let's say you already have a student in school and you've already borrowed money before July 1st of 2026. Then you might not have to deal with these loan limits at all until they finish their program. This is something called a legacy borrower or an interim exception. This basically means that your student, if they stay at the same institution in the same program, then you don't have to have a $20,000 cap to borrow for a Parent Plus loan up to 3 years or when they're done with their program, whichever is less. So you want to make sure that you double check everything. you need to ask your financial aid at your institution to make sure that you know exactly what your loan limits are for 2026. Now, if you're planning ahead for your child and they have not started college yet or school yet, then you do want to plan for the $20,000 annual cap and the $65,000 lifetime cap, because that does begin starting July 1st. So any new loan that's borrowed after or on July 1st of 2026, you will expect these limitations. Now let's talk about what this loan will actually cost you, because the interest rate on Parent Plus loans is the highest out of all federal loans. And so you really want to calculate, is this worth it? So as you can see from this chart, for loans dispersed between July 1st in 2026 and June 30th of 2027, the Parent Plus interest rate is 9.07%. Yes, you heard me correctly. It is 9.07%. That's up from 8.94% the year before, and it's meaningfully higher than the 6.52% rate that your student will have if they happen to borrow federal loans. On top of that rate, there is a 4.228% of an origination fee. Now, if you're not familiar with this, this basically means because you want to take out a loan, a federal loan, there is a fee to do so. So there's going to be a percentage of what you borrow to be taken on top of that. So for example, if you're taking out $20,000, you want to multiply that times 4.228%. That is the fee that comes off the top of the $20,000 before it even reaches the school. So in short, you're not really taking out a full $20,000. You're actually taking out less than $20,000 in order for you to finance your student's education. So if you actually needed $20,000, you will still be short because you don't have $20,000. Let's give a concrete example so you can really see what this all means. So let's say you borrow $20,000 this year at 9.07% on a standard 10-year repayment plan. Over the life of that 1 year's plan, you're looking at roughly $9,300 to $10,000 in interest alone. That's on top of the $20,000 that you borrowed. That's somewhere between $254 a month for the next 10 years. Again, that's $254 a month for the next 10 years. And that's just for 1 year. So as you can see, the Parent Plus loan can be a very expensive investment and something that you really want to calculate and understand before you sign. Now let's back up to talk a little bit about why this interest rate matters. Because for some, you might just think, I just need the $20,000. It doesn't matter what the interest rate is. But let's look about why it matters. So the interest rate is fixed for that particular loan their entire life if you're taking out a federal Parent Plus loan. But it resets every year based on what the Treasury has set. So that means if I borrow this year at a 9.07%, that means next year, while my child is a sophomore, it might not be 9.07%. It could be higher or lower. And that means my monthly payment might be different, which means I can end up with separate student loan payments for the next 4 years or until my student graduates. So that's why you want to track each loan's interest rate and don't assume that it's not a big deal or it doesn't matter, because it does matter on your monthly payment. The reason why I really want to make this video is because there's so many parents who take the gamble for their student because they want to support their student, which is fantastic. But what they don't realize is that interest rate or the cost that it could impact their own retirement or even their financial security, not their student's future paycheck. This impacts you. It's important to note that a Parent Plus loan cannot be transferred to your student once you've taken it out. You as a parent has taken out that loan, then that means you as a parent are responsible for that loan. Here's something that catches parents off guard, and I want to make sure that you clearly hear this. The One Big Beautiful Bill Act has come out with two new repayment plans. One, the Repayment Assistance Plan, also known as RAP, which is a new income-driven repayment plan. And then the other is a standard tier plan that is not an income-based repayment plan. Let me make this clear. Parent Plus loans are not eligible for RAP. They are not eligible for the income-driven repayment plan. Now, why is this important? Let's talk about the difference between having an income-driven repayment plan and having a fixed monthly repayment plan. The standard plan is a fixed monthly repayment over a set term, typically 10 years, though it can extend longer depending on the total balance across all your federal loans. So earlier, remember I talked about your loan limits and saying there's $20,000 is your annual cap. Well, that is in the range for a 10-year repayment plan. As you increase your loan amount, then that also extends how many more years that you're in repayment. Unlike an income-driven repayment plan, where your plan is based on your income at the time. The standard fixed monthly payment is not based on your income. It is based on the total amount of loans that you have that determines how long you will be in repayment. Let's make this clear. It does not adjust if you retire, if you lost a job, or even if you face financial hardship. The monthly payment amount does not change based on your income. It is going to be based on the amount of years that is required for you to pay off that total amount. Listen, this is significantly different risk than your student who may be taking out a federal loan. They do have access to income-driven repayment plans that are based on their income. So you want to know the difference of what it means for you to take out a loan versus your student. I want to make a note here about consolidated loans. So earlier we talked about if you're a parent that's taking out a loan every single year for your student, how they can have different interest rates and therefore different monthly payments. Well, there is an option where you can consolidate your loans so that all four payment for each year can be rolled into one, making one interest rate and one monthly payment. That is what we call a Parent Plus consolidated loan or a direct consolidation loan. Now, historically, these consolidated loans did have access to an income-driven repayment plan called income contingent repayment or ICR, which means that this will no longer be an available option. So you want to make decisions based on a fixed monthly plan budget rather than an income-based one. So what am I saying? What I'm basically saying is that you need to be confident that you can afford the monthly payment at a 9.07% if you plan to take out a loan this year. Regardless of what happens with your income, regardless of what happens to your job, and regardless of your retirement plan. This is a different conversation that you have to have that your student is not having if they're taking out their own loans. So, should you borrow this year? Well, based on everything we talked about, let's break this down into 5 steps that will help you answer that question more confidently. The first thing you want to do is you want to calculate the gap. What is the gap? After grants, scholarships, and your student's own financial loans, what is the actual dollar amount left to cover? The second thing you want to do is you want to look at your standard tiered repayment plan. Can I afford this at a 9.07%? If taking out $20,000 creates a monthly payment that is not comfortable for you, then you want to consider a lesser amount of borrowing limit for yourself, or you may want to think about other options that will help you close the gap that does not mean for you to take out the maximum for your Parent Plus loan. That's information you need to know now, not in 6 months when the bill arrives. The third thing you want to do is protect your retirement plans. You've earned it. You earn the right to retire. But please note that Parent Plus loans do not get forgiven just because you retire. So you want to think critically. If I take out this loan, will it push back my retirement plan? And is that a decision that I'm willing to make? The fourth thing that you want to do is actually compare borrowing privately versus federal loans. Yes, some private lenders offer a lesser interest rate than the 9.07% that you're getting federally for parents who have a strong credit history. But there's also a downside. Some private lenders can have variable rates, interest rates, or may not even have more repayment options for you. So you really want to think, is it safer to do a federal loan, or is it better to try to do a private loan? Can I do maybe a mixture, maybe some federally and some privately? If the remaining balance is a significant gap, then it is worth comparing your options, especially if you have multiple children going to school or currently in school. You want to do the calculations. And the fifth and final thing, because you know that I'm passionate about free money and helping you to avoid student loan debt, I need you to encourage your student. I need you to make your student apply for free money for school. It is not too late. Yes, school starts around the corner, but it is still scholarships available all summer long, all fall semester, all spring semester. There is never an excuse to not be applying for free money to help you to either avoid taking out Parent Plus loans, to help your student avoid taking out federal loans, and also to make sure that you have a closer opportunity to graduating with less debt or even debt free. So that's all, everyone. I hope this video was very helpful for you parents, because you need to know how you can best support your student and not create a greater burden for you and your family. So if this video was helpful, we would love to have you as part of this community. Go ahead and subscribe, share it, tell other parents so that everyone is aware about what is happening in 2026 and beyond. I look forward to connecting with you. Please tell me in the comments if you have a student heading to school or already in school. If you have any additional questions, I read every comment and I look forward to helping you along this journey. Until next time, bye-bye.